we're gonna go ahead and get started. Thanks for joining us today for our online homebuyer workshop. I sent a couple of messages out to you requesting that if you have not filled out the intake form and the budget, please do so. We are going to be going over your budget section tonight during tonight's workshop. So we do need that information completed, and check your email if you didn't get that information. And I'll give you a little bit of time to complete it tonight through the workshop. So thanks again for joining us. We're going to go ahead and get started. My name's Connie Dertarosian. I'm with HomeownershipOC. I'll be your host tonight. And a little bit about myself. I have over 20 years experience in the nonprofit housing counseling area and have taught lots of credit, homeownership, foreclosure prevention classes. And I am a HUD certified housing counselor. So hopefully I can answer all your questions tonight. And if not, well, I will definitely outreach to our experts and get you the answers that you need. All right, so a little bit about HomeownershipOC. We are a nonprofit HUD-approved housing counseling agency, and our mission is to promote and preserve the dream of homeownership through outreach, education, counseling, and financing. We were started in 2007, and we've done over 75 housing events and workshops, educated over 17,000 individuals on homeownership, credit, foreclosure prevention, and avoiding real estate scams. And we do partner with various organizations to do this work, one of them being the Fair Housing Foundation. They do help us with rental and fair housing information as well. So if you have questions about that, we can certainly help. All right, so we're going to break up tonight's workshop into two sections. We will be completing the whole thing tonight. So the first part, we will cover assessing your readiness to buy a home, credit, savings and spending, and obtaining a mortgage loan. Then we're going to take a little bit of a break, about a 15-minute break or so, and then we'll come back and we'll finish it up with shopping for a home, managing your debt, working with the realtor, protecting your investments, and what are the next steps. So I do want this to be an interactive class, so it's not just me talking. Please do ask your questions. You can ask a question in the chat box or in the question box, and I'll be happy to get to your questions. All right, so we've got a lot of information tonight, so I'm going to go ahead and we're going to get started. We'll talk about assessing your readiness to buy a home, and start with some of the advantages. So, all right. So if you're having trouble hearing at all, then you might want to try calling into the number instead of using your computer audio. Sometimes when you do both things over the internet, it's not so good if your internet's not so good. So try calling into the number and using your phone to connect to the Zoom call. That may be a better way to hear the information. All right, so we're going to talk about the advantages of homeownership and the disadvantages. So advantages, of course, you have control over your environment, you have stability, tax benefits, building equity, and assets is also a great advantage, and it is an appreciating investment. Some of the disadvantages would include there are no guarantees, you do have decreased mobility, you are responsible for maintenance and repairs, and there are monthly costs, and it is a long-term investment. Excuse me. All right, so get a little drink here. All right, so renting versus buying. Of course, as a renter, you're responsible for gas and electric. Pardon me. As a homeowner, you'll be responsible for gas, electric, water, trash, property taxes, homeowners insurance, repairs and maintenance, and of course, HOA fees as well. Let me try to get this tickle out of my throat here. All right, so as you can see with homeownership, there are some additional expenses that you will be responsible for, which is why you want to work with your housing counselors so that you're ready for those additional expenses. Let's map out a plan to meet your homeownership goals. So first thing we start off with is, what can I afford to buy? And affordability depends on several important factors. First thing is your annual gross income. Second is your credit history and score. Next would be current mortgage rates. Current mortgage rates are really good, which increases your affordability, so that's a plus. Down payment, how much money do you have to put down on a home, the type of home you're going to buy, your current lifestyle and future plans. And then, of course, there's always fees and closing costs that are also, fees and closing costs will be included in the cost of homeownership, right? So we need money for down payment and closing costs and the fees associated with purchasing a home. So what are the steps for buying a home? First, you're going to prepare yourself for homeownership, which this is the best place to start. You're going to learn about the whole process tonight. Then we're going to determine how much you can afford. You would next apply for your mortgage loan, get your mortgage loan pre-approved. Then you decide what type of home you'd like to purchase. Go out and shop for that home. Next, you'll make an offer or counter offer on a property. Then you'll get your home inspection. You'll complete the tasks that are required during escrow, and then you close the loan. And that's basically the 10 steps of the home buying process. So we'll go into detail about each one of those steps tonight and kind of, jump in deep. So again, if you do have questions, feel free to send them to me in the chat box, and I'll be happy to answer questions for you. So what does HomeownershipOC do? We provide coaching, individual counseling. You can, after this class, sign up for individual one-on-one counseling. You will also receive your HUD home buyer certificate after completing this class, which is a requirement of many first-time buyer programs as well as down payment assistance programs. We'll be going over all those programs tonight, or at least a variety of them that are available, so you can get an idea of what kind of programs are out there and what you might be eligible for. We also offer post-purchase counseling if you're having issues after you close your loan. We're here to support you. All of our services provided free of charge. So feel free to use us as a resource. All right, let's talk about savings and spending. So we're going to plan how we spend our money, and it's best to track your income and expenses. That's one of the reasons why I have you working on your budget. So again, if you haven't completed the intake form, didn't complete the budget, you can do that as I'm going through the slides. Complete that budget section and send it off to us. It's one of the first things that we have you do when you're looking at homeownership. So we need to know how much money is coming in, how much money is going out, and do we have any left over that we may be able to put into a savings. You're going to want to track your income and expenses, review and make adjustments, decide what is necessary, maybe areas where you can trim, boost your savings, set a pattern to boost your savings every month, and know your triggers for overspending and address those underlying causes so that we can stay on track with our budget. So when I talk about a budget, or what I like to call a spending plan, what kind of words, negative or positive, may come to mind to you when you're thinking about budgeting? How many people are currently using a budget? Send me a message in the chat box and let me know. if you currently use a budget, do you have a budget? Do you hate the word budget? Do you like spending plan better? And what do you think are some of the benefits of tracking your spending? If you're living paycheck to paycheck, I can tell you tracking your spending is one way to figure out where you're spending all of your money and how we may be able to get back on track. And figure out, where your money is going. A lot of times clients don't even know where the money is going. It's also important to have a savings plan in addition to a spending plan. Savings and spending plans can help you estimate what you can afford to pay in a mortgage, identify where you may be able to cut some expenses. It can also help you with developing a stronger loan application, and also prepare for those additional costs that we talked about, as well as provide some motivation. So, important for you to keep track of your spending and your savings. And there's a lot of different tools that are available to assist you with this. So you can use a notebook, write things down, write it down on a monthly basis. You can use your calendar as you get paid every 2 weeks or bi-weekly, bi-monthly, whatever it may be. You can track it that way. There's a lot of online tools that are available as well. One of them that I like a lot is called mint.com. So it's made by the company Intuit that does the tax return stuff. And you can connect your bank account to this online tool, and it will track your spending as through your bank account. So as you use your ATM or pay your credit cards down, it will help you create a budget, and it will also track your spending. So if you say, I want to spend $400 on groceries, it will track your grocery spending and see, are you on track this month, or are you over or under? So it's a really great tool. So write that one down, mint.com. Really great tool if you like those online applications. Really simple to use, and as I said, you can create a budget in there, and it can help you with tracking your monthly spending to see if you're on track. You can also keep track of your receipts every month, add those up. Some people like an Excel spreadsheet, and they put the information on there. Feel free to use the sheet that I sent over if you want to use that as your budget, and you could track it every month. And also some of the banks are also offering online tools through their online banking. So you can track your savings and spending that way as well. But it's important for you to empower yourself to be able to get a hold of what you're spending, and in order to know what money's coming in, what money's going out, and to also establish a savings plan. So first thing we need to do is determine what is our gross monthly income. Then we'll calculate our monthly expenses, and then we subtract the expenses from the income and determine if we have any extra monthly income. So then we'll review the savings and spending plan and consider making adjustments to our monthly income and expenses. All right, so how do we determine our net monthly income? That net income is the money you earn after taxes or payroll deductions have been taken out. If you have a side job, or maybe you do babysitting or Uber or something on the side, you can include that extra monthly income. So at this point in the workshop, we're going to complete our monthly workshop, our monthly budget. So if you all should have gotten the email that I sent you that had a copy of the budget form. It's also included in our intake form if you have a copy of your intake. It has a place where you can put in your monthly income and expenses, and then it has a section where you can complete your monthly budget. So I want you guys to take a few minutes and complete that section so we can go over it for the next part. And we'll be creating our monthly budget, so this will be the starting point. And from here, we can use it to track our monthly expenses. So go ahead and take a few minutes and complete the budget section. You can do that kind of as I'm talking through the process. And you guys are not being very interactive here. So does anybody currently have a budget? Do they use anything? Do they want to share any tools? Send me a message in the chat box if you do. Chat box or in the question box. All right, so as you're completing your budget section, we're going to calculate our monthly expenses. So we're going to fill out all those sections there, your monthly rent, mortgage, gas, electric, water, trash, cable, internet, cell phone, anything else you may have as a monthly expense. So expenses are items you obviously spend money on. They can be fixed or flexible or periodic. Something fixed would be something like your monthly rent, always due on the first of the month. Something flexible would be maybe your grocery bill, eating out bill. Periodic may be something like your auto insurance. It could be paid quarterly. As you're calculating your expenses, you know, get that monthly amount, even if you do pay it every 6 months or whatever it is, just divide it by 6 to figure out what the monthly amount is and put that monthly amount down. So once we've completed that on our budgets, we're going to look at our total monthly income, and then we're going to add up all of those expenses to get our total monthly expenses to see, are we positive or negative at the end of the month. So you all do this, work on your budgets, figure out what is your total, and we're talking household income, right? And what are your total monthly household expenses? So let's say we make $4,000 a month. Our total monthly expenses are $3,500. That would leave extra income of $500. And we could use that to pay down our bills or set up a savings plan. Hopefully you're in the positives. So you guys complete that section. Let me know if you have any questions as we're going through this. So it's, as I said, it's really important for you as a future homeowner to know how much money's coming in, how much money's going out, and to stick to your spending plan. So as we complete the budget, we can make this a monthly spending plan as well. So each month you can fill in that. You have the budgeted amount that you think you're going to spend. Then we can fill in the actual amount. So let's say, for instance, you know, groceries, we have $400 a month, but we go over and we spend $450. It'd be off your spending plan, right? So it's a good idea to track your spending for at least 3 months for really accurate data. You could start with just 30 days and then do 60 days, but 3 months is really the best way to go. And as you track your expenses, which costs seem to always be over the planned amount? Maybe we're going out to lunch all the time and that the amount we've allocated for eating out is over budget. Then we just need to work on that. Maybe bring our lunch so that we're not going over in that area. How important are your homeownership goals? Are you ready to consider trimming flexible expenses? And are all members of the household willing to follow the plan? Because if you have kids, we know how they are. They're always asking for money, right, to spend money on things. And so if we know we only have $200 extra and that's our flexible spending and we can't go over that, then we've got to stick within that budgeted amount, right? We can't go over. So really important for you to create that savings plan and yeah, stick to it on a monthly basis so that we can stick with our stick with our homeownership goals. All right, good job for y'all that have completed the budget, and definitely send me a copy of it if you haven't done so already. We're going to create and follow our spending plan. We're going to start saving for homeownership. So hopefully as you did that experience and did your budget, you had some money left over. We want you to set up a goal for homeownership, boost your savings, pay yourself first. So let's say we have $200 extra every month. Let's say we're going to put $100 into our savings and $100 into our emergency fund, so that we have additional, an emergency fund available just in case emergency happens, right? You can always seek additional funding. Perhaps when you get your tax returns, you can use those extra dollars to help boost your savings and your homeownership goal. It's a good idea to have an emergency savings plan of at least 3 months of your expenses. 6 months is actually better, but I know with the high cost of things, most people don't have 6 months of savings to be able to pay their expenses. But as you know, we all experienced COVID-19. People were slow to get the unemployment money. The people who had savings plans and had emergency savings were in a better situation. So it's a good idea to have an emergency savings, and especially as you're looking towards homeownership, you're going to want to have some funds available. You are going to need some funds in order to purchase a home. Even if you are getting down payment, there are going to be closing costs and fees. So really important for you to have some savings available. So if you're going to send me your intake forms, you can email it to me directly. You can use the email, just reply to the email that I sent it to you, but I'll also send it to you guys in the chat box. If you're using the online intake form and you're completing it that way, I'll get a copy of that. So just go ahead and fill that out. It's on our website on the programs page. Scroll down, complete the online intake form. There's a budget section in there, and send the whole thing. Once you send it off to me, it will come directly to me. All right, so additional ways you can boost your savings is look for some additional ways to save some money every month, and anytime you get some extra money, maybe through your tax returns, use that, not to just go on vacation, but to boost your savings for homeownership. All right, so what's the best way to manage our money? Number one is pay your bills on time. You don't want to be paying those extra interest fees or late fees. Keep your credit score high or improve it if it needs improving. Control your day-to-day spending and create a spending plan and stick to it. So we're going to talk a little bit more about credit. Credit is also really important when you're purchasing a home. It's really an x-ray of your financial health and how you've dealt with it in the past. And it's important to have good credit when buying a home, because lenders are more likely to give you a loan if you've handled past borrowing responsibly. So that would show that you have good credit. A higher risk loan from the lender's perspective will mean higher interest rates. So we don't want that. So that's why we work with a housing counselor to really get your credit score in tip-top shape so you're getting the best interest rates available. You will save money on loan interest rates with a higher FICO score. So we want to get you as high as possible. So it does take time. We're going to go over some tips on how to improve your credit score. So it does pay off to have a good credit. This is an example of, let's say, a 30-year mortgage on a $250,000 home, and the difference you would pay according to your FICO score. So FICO scores range from 400 up to 850. And as you can see from this chart here, if you have a monthly, so with a higher FICO score with between 760 and 850, your monthly payment on a $250,000 home is going to be $1,207. And your annual percentage rate will be 4.096. Total interest paid would be $184,670. So higher FICO score equals lower payments, more savings, right? Versus, let's say we've got a 620 FICO score, your interest rate is going to be 5.684. Your monthly payment is going to be about $1,448, and you're going to be paying about $271,448 in interest paid over the life of the loan. So almost $100,000 more in interest. So it really does pay off to have the higher FICO score and the better credit. All right, so your credit report is a detailed summary of your credit history put together by your credit reporting agencies. There are 3 credit reporting agencies, which include Experian, TransUnion, and Equifax. You all are entitled to a free credit report through annualcreditreport.com through each of the 3 major bureaus. They do not provide a FICO score for you, but it is a great way for you to check your credit and check it on a regular basis. I understand through COVID-19, through this pandemic, they're allowing you, it used to be once a year, you could check it through each of those 3 bureaus, but now they're letting you check it weekly. So if you have not checked out your credit report, go to annualcreditreport.com, check it out. It's super easy to use and view each one of those credit bureaus, each one of those reports to your credit bureaus. If you do see something on there that shouldn't be on there, it's very easy to dispute it through annualcreditreport.com. There are some other tools you can use for viewing your credit. You can go to My FICO, Credit Karma, My Bankrate. They allow you to purchase your FICO score. Credit Sesame is also another one. Credit Karma is free. It will give you an idea of what your credit score is. Just know that it's not going to be the most accurate. What a lender is going to look at is a merged credit report, tri-merge. So it's going to take all 3 of those, merge them all together and come up with your FICO score. But you'll get a good idea of where you're at with Credit Karma or Credit Sesame. So check those out. It's a good idea to check your credit at least every 6 months. I'd say, every 3 months now with all the identity theft and things that are happening. So annualcreditreport.com. So make sure you do check out your credit report. There's different types of credit reports that are pulled. There's a soft pull or a soft inquiry, which does not affect your credit score. There's a hard pull or a hard inquiry, which does affect your credit score and is an in-file credit report. So if we, as a counseling agency, pull your report, it does not affect your score. We're just reviewing it so we can review it with you. If a lender or you're applying for a car or an apartment, that would be a hard pull and it does affect your score and it will be an in-file credit report. So how do they come up with these FICO scores? So FICO scores are based on 5 main categories in your credit report. Of course, higher scores are better. Most consumers are between 300 and 850, and a higher FICO score means you'll likely have to pay a lower interest rate. So from this pie chart, you can see that 35% of it is payment history, 30% is the amount owed, 15% is length of credit history, and 10% is new credit and types of credit used. So most important thing is paying your bills on time because payment history is 35% of your FICO score. And we're also going to talk about amounts owed, but paying your bills on time Your payment history, 35% is, a huge chunk of your FICO score. So that's the first thing that we're going to tell you to do to improve your credit score is pay your bills on time. If you've gotten behind, get back on track, start making those payments on time. So avoid closing accounts with positive payment history and keep making your payments on time, even if you just have to make the minimum payment. Amounts owed are 30% of your score, so use 30% or less of your available credit limit when you're on credit cards and other revolving loans. So let's say, for instance, you have a $1,000 limit. Keep that amount to $300. The balance on there is $300. So 30% is best. And better than that is to just use your credit card and pay it off every month. Use your credit card, pay it off every month. When people ask us, how do we establish credit? You can get a credit card, use it, pay it off at the end of the month. Use it, pay it off at the end of the month. That shows a good, responsible person using their credit wisely. New credit is 10% of your score. So as you're shopping for things, maybe you're looking for furniture or a car, do it within a 14-day window, 14 to 30-day window. So it counts less on inquiries in your and new credit on your credit report. And new lines of credit, such as purchasing furniture, co-signing a loan, things like that can negatively affect your credit score. So just know, if you're co-signing for somebody, that does they are going to pull your credit and it will affect your credit score. Your credit report should reflect accurate, current information, accurate monthly payments, and know that the lender is going to look at your credit report to look at what are your monthly payments on those credit cards or car loans or whatever it is, and it can affect your debt to income ratio, which we will talk about a little bit later. Now, if you're already working with a lender, always get the lender's approval before making any changes to your credit profile. Because it can affect your ability to purchase the home. So don't go out buying new cars, new furniture and things like that when you're pre-qualified to purchase a home, because it can affect your approval status. Now, what's the best way to boost your credit? Pay your bills on time. If you've missed payments, get current, stay current. Be aware that paying off a collection will not remove it from your credit report. If you are having trouble making ends meet, contact your creditors, try to work out a plan with them, and ask them to waive the late fees or not report it. They usually work with you. You can also work with us to work on improving your credit for free. Amounts owed tips, keep balances low on credit cards and other revolving credit. Be sure to pay off debt rather than moving it around, and don't close unused credit cards as a short-term strategy to raise your score, and don't open new credit cards that you don't need just to increase your available credit limit. Best thing to do, use your credit card, pay it off at the end of the month, or make a plan to pay it off as soon as possible. New credit tips, do your rate shopping for a loan within a given period of time, usually 14 to 30 days, and reestablish your credit history if you had problems in the past. Note that it's okay to check and check your own credit report. You should be doing that, as I said, at least every 6 months you should be checking your credit report. You can do that for free through annualcreditreport.com. All right, any questions on credit? Ask me any questions you may have, and do that through the chat box or the question box, okay? So we're gonna do a little activity here. I'm gonna give you 3 scenarios, and you tell me, who do you think has the higher credit score and why? So we have Susan, Jonathan, and Maria. All right, first we're gonna talk about Susan. She has an annual income of $31,750, a car loan for $12,760. She has 1 credit card and it's paid off. The second credit card has a limit of $7,500, and she has a $4,000 balance on that card. She has never missed a payment on her credit cards. All right, so that's Susan. Then we have Jonathan. He has an annual income of $52,000, no car loan, no credit cards. He pays everything with debit card or cash. And then we have Maria. She has an annual income of $40,000. She paid cash for her car, so she doesn't have a car loan. She has one credit card with a balance of $12,000 and a limit of $12,500. And she has missed 2 payments in the last year because she was traveling. So out of these 3, who do you think has the best credit? Is it Maria, Jonathan, or Susan? Which one do you think? Send me a message in the chat box. We got Susan. Remember her scenario. Okay, very good. So y'all are paying attention. So yes, Susan would be the one that has the best credit rating because she's paying her bills on time. She has one credit card that's already paid off. The second credit card, she's a little high on the balance, but she's never missed a payment on her credit cards, which is great. And then we have Jonathan. Some people think Jonathan would have a good credit rating, right? But he actually has no trade lines. So that sometimes can also work against you, and you can have a very low score if you don't have any credit. So what we would recommend for Jonathan is that he gets some credit cards, he use them. Instead of using a debit card, he could use his credit card for groceries and things like that, and then just pay it off at the end of the month, and that will help him establish his credit. You usually need about 3 trade lines, at least 3 accounts on your credit, and for a few months. Now Maria, she's missed a couple of payments, and she's getting up there with her credit card balance, so she definitely could benefit from some credit counseling. All right, so as far as bankruptcy, how does it affect your credit? It will factor into your score as long as it remains on your credit report. Chapter 11 and 7 will stay on there for 10 years. Chapter 13, bankruptcies, up to 7 years. A lot of times people say they're going to file bankruptcy because they've got a lot of debt. And you really want to talk to a credit counselor before you do that, because sometimes you can work things out without having to claim bankruptcy. Claiming bankruptcy will affect your ability to qualify for a mortgage. FHA has a minimum waiting period, I believe, of 2 years, and other qualifications based on the chapter filed. It's really important for you to understand the ramifications of bankruptcy and make sure that that's the best option for you. We always say try to work things out with your lender, with your creditors prior to filing bankruptcy. And some people, bankruptcy is the answer, but just know what you're filing and what you may be responsible for in the future, and that it will affect your credit. Best way to improve your credit. So your credit score is based on information in your credit file, and it takes into consideration all the positives and negatives information in each category. It has no memory of your last score. So even if you've had a long, ugly credit history, your score will be weighted in favor of your last performance. So the best way to improve your credit is to turn over a new leaf. Start by rebuilding your credit history. It does take time. You'll be given points for positive, and points are taken away for negative. So it's important to reestablish positive credit history to offset the negatives. So if you've had late in the past, start making your payments on time. Those positive points will begin to accumulate. How recent, frequent, and severe the negative is will impact the score. As negative information seasons out, and you begin to utilize credit responsibly, you can definitely improve a negative credit score. So it does take time, but what you have to do is replace the negative things, the negative collections, make arrangements with them to pay those things off. Start paying your bills on time. That will put positive things on your credit score, on your credit report, so it'll improve your score. Now, the truth about credit repair is no one can guarantee to remove accurate information from your credit report. You cannot remove a foreclosure. You cannot remove a bankruptcy. You cannot remove any of those things. Even though people claim they can, they can't. It takes time to rebuild your credit, and you can start today and working on it. Also, no one can legally create a new identity for you. Legitimate companies provide a service before requesting payment, and there are credit reporting laws that regulate credit repair. And what we recommend is, rather than working with those companies, which majority of them are a scam, take the money you would have used for that credit repair and pay down your debts, or obtain a secured credit card from your local financial institution and start rebuilding your credit history. And start putting some positive things on there. Those people who say that you can pay $250 and they're going to improve your credit overnight, write letters for you and all of that is a bunch of baloney. After 30 days, the information all comes back and your credit history is the same or worse, maybe. As I said before, you can get a free copy of your credit report, annualcreditreport.com. You can send your own dispute letters. Annualcreditreport.com lets you dispute transactions on there. You can also upload information. It's super simple to do. And there's lots of resources out there. You can go to credit.org. They have a lot of resources on their website as well. But most of this information you can do yourself. It's important that you know your rights, the Equal Credit Opportunity Act and Fair Housing Act. You have a right to have a mortgage application reviewed without consideration of race, religion, age, national origin, sex, or marital status. The Fair Credit Reporting Act gives you the right to a free credit report once a year, and you're able to dispute settlements for errors. And the Fair Debt Collection Practices Act guarantees users' rights with dealing with creditors. So they can't harass you. They can't say you're calling and say they're going to send you to jail or report you to your employer or things like that. You can also tell creditors that you only want to be contacted through mail and you don't have to take their calls. So if they're harassing you, you can tell them, just send me a letter. For more information, you can go to the ftc.gov. They have lots of information on credit reporting agencies and collection agencies as well. All right, so we finished the credit section and the budgeting section. Any questions? Send me a message in the chat box or in the question box. We are going to jump into the financing of a home and talk about how mortgage loans work. All right, so what is a mortgage loan? A mortgage loan, which is also known as a deed of trust in the state of California, is a secured loan agreement between the lender and the buyer in which the property is held as collateral for the loan. You'll usually work with either a mortgage broker or a loan officer to apply for your loan. A mortgage broker is an intermediary between the lender and the customer and shops loans from different financial institutions and different loan products. And the difference between a mortgage broker and a loan officer is the loan officer usually represents a lender or a financial institution and may work for a specific bank like Bank of America, Chase, Wells Fargo, US Bank, that would be a loan officer. Mortgage broker is really someone who can shop things around and look at different products to see what's going to meet your needs. Now, who originates mortgage loans? Of course, we have the traditional banks. There are traditional sources of mortgage loans and often have many products and programs. One advantage of borrowing from the bank is being able to keep all your financial activity in the same place. We usually tell clients to go check out wherever they bank to see what kind of programs they might have. We'll be talking about down payment programs and first-time buyer loans, and most all of the banks have down payment programs or first-time buyer loans. Now, mortgage companies, mortgage bankers only make loans that are secured by mortgages on homes. So mortgage companies also originate mortgages. And one advantage of working with a mortgage company is that they specialize in mortgage loans, and they may have various loan programs at various interest rates. So it's a good idea to shop around. You can also go to a credit union. And one advantage of borrowing from a credit union is they usually give their members good mortgage loan terms, fees, and rates. Again, it's a good idea to shop around. Some nonprofit organizations and community development organizations receive money from the government or grants to lend. And so they'll provide first-time buyers some programs. So sometimes you can get a loan from a nonprofit organization. Most of those are down payment or first-time buyer programs. We'll talk about some of them. And then we have government agencies who also originate loans. So we have state or local housing finance agencies. Majority of them are focused on first-time buyers. You have the USDA, Rural Development, that also offers government loans in rural areas. One advantage of borrowing from a government agency is that they have financing available at lower interest rates, usually require lower down payments and closing costs because they're working to try to help low to moderate income and first-time buyers get into homeownership. So we're going to talk about some of the different programs that are available here in Southern California. So what makes up your mortgage payment? Your mortgage payment is made up of the principal, interest, taxes, and insurance. Principal would be the part of the mortgage that is applied to the original amount borrowed. Interest is the amount that the lender charges for lending the money. Taxes is the part of the mortgage payment used to pay property taxes. And the insurance is the part of the payment used to pay homeowners and sometimes mortgage insurance. So an example, let's say we've got a $250,000 home. We're going to put 10% down. That would be $25,000 for 30 years. Property taxes are assumed at 1.5% of the purchase price, but can vary. And homeowners insurance in California averages about $800 to $1,000 a year. So that would be all of the expenses included in the principal, interest, taxes, and insurance. So it's not just the amount that you're borrowing, but we also have to look at taxes and insurance as well. That's your full mortgage payment. Some factors that may affect your mortgage payment is how much you put down, repayment terms of the loan, loan interest rate, and does it include homeowners association fees and mill arrears. All right, so I definitely need to know the answers to those questions. Let's see, where are we at as far as time? Oh, we're doing really good on time. All right, so as far as affordability goes, so when looking at your affordability, you will often be pre-approved for a loan when your housing payments and debt payments are equal to or less than 43% of your gross income. So when we talk about housing payments, as I said, it does include mortgage, property taxes, property insurance, and any HOA dues if there are included in the property. Debt payments, we're going to look at your loans, car loans, credit cards, child support, and any other revolving debt. Other things we're going to look at is savings, investments, etc. And your household expenses would include all your living expenses, food, clothing, etc. When they're qualifying you for a loan, they're going to look at your credit report and look at what loans do you have, what car loans do you have, what credit cards do you have, what are your monthly payments, what's your revolving debt. And what we want is less than 43% of your gross income going to your housing payment and your debts. Okay. So we're going to talk a little bit about ratios here and how they come up with those ratios. So the less debt we have, the more purchasing power we have. So in the scenario on the left, with 5% of our income used for paying off debt and 38% available for a housing payment, this person would be able to qualify for a higher mortgage loan rate, mortgage loan. Let's say, for instance, that we have 15% of our income is used for paying off debt. That would mean that we only have 28% of our remaining income that's available for housing. So that person does not have much income available for their home and has lower purchasing power. So one of the reasons why we encourage you to do the individual counseling is so you can pay down all those debts and have more money available for your housing payment. Obviously here in Orange County in Southern California where we live, housing prices are high, right? So you need more money available for that housing payment. Best way to do that is to pay down your debts and have less expenses so that you have more money available for your housing payment. And this is what lenders are going to be looking at. So they talk about your housing ratio or your front end ratio, and the way that they calculate this is the housing ratio is your maximum percentage of a borrower's income that can be used to make a monthly mortgage payment. Let's say, for instance, you make $6,000 a month. Your monthly housing cost is $2,000. That would mean you'd have a 30% housing front end ratio, or 30% available for your housing payment, which would include your loan payment, your principal, interest, taxes, and insurance. All right, so that's the front end ratio. The back end ratio is your debt to income ratio. So you'll hear DTI a lot, or debt to income ratio. So that represents the maximum monthly amount the borrower can spend on a house payment plus all their debts that are owed to the creditors. All right, so in this scenario, we have our mortgage payments are $2,000, car payment $300, credit cards $200. That would mean our total monthly housing and debt payments are $2,500. So if we take $2,500 and divide it by our $6,000 monthly income, we have a 41% debt to income back end ratio. So remember when we said we wanted it under 43%? So this would be definitely under 43%. So although each situation varies, a front end ratio higher than 38% or a back end ratio higher than 43% signals that you may need to lower your debt and control use of your credit before attempting to purchase a home. They'll probably send you to us so you can work on managing your finances and paying down some of your debts. All right, so I don't want you to get too confused with the housing ratios, but at least you kind of understand where lenders are coming from and why they're going to ask you for that information on your credit report and your debts so they can figure out your affordability. Now, how do we calculate affordable monthly payments? We multiply our monthly gross income by 0.43, which is the standard back-end ratio, then subtract the monthly debt payments from the total. So this would leave us with the amount we could afford to pay each month for a mortgage. So again, going with our $6,000, we make $6,000 a month. We're going to multiply it by 0.43, which is our standard back end ratio. Then we're going to subtract 580, which is our monthly debt payments. That would leave $2,000 available for our monthly housing payment, affordable monthly housing payment. All right, so that's kind of just the basic math of calculating affordability and how lenders are going to look at your information to see whether or not you can qualify for the loan. As I said, big picture item here is that the less debt that we have, the more we have available for our housing payment. So we want to pay down those credit cards, pay down those auto loans so that we have more available for our housing payment. You may also hear about loan to value ratio, or LTV. That's the ratio of the loan balance you owe to the appraised value of the house. It's used during the loan approval period to gauge risk. A higher LTV percentage, the lower the risk, and typically the lower the interest rate. Lower the LTV, the higher the risk, and the typically higher interest rate. An LTV of less than 80% is ideal. And the way you calculate it is we divide the appraised value of the property by the mortgage amount. In this example, we have a $400,000 appraised value. We're going to get a mortgage of $260,000. So we divide $260,000 by $400,000, and we get a 0.65 or 65% LTV. Higher LTV, the lower the risk, and lower the interest rate. So again, you don't have to worry too much about this stuff because your lender's going to do all of this calculations for you, but I at least want you to know what they're talking about when they're talking about LTVs, front-end ratios, back-end ratios, and how they calculate those things. All right, so any questions? Send them to me in the chat box or in the question box. I'll be happy to answer those for you. All right, so I think we'll do a little bit, maybe five more minutes or so, and then we'll go ahead and take a break. So we're going to talk a little bit about comparing mortgage loans. We're zooming right along here, so if you do have any questions, feel free to send them to me in the chat box or in the question box. I'll be happy to answer your questions. All right, there's basically 3 different loan categories. There's government insured or guaranteed loans, and then we have conventional, and then we have non-conventional. Government insured loans include loans from private lenders that the government insures or guarantees, such as FHA, VA, which is the Veterans Administration, USDA, or Rural Development, etc. Conventional is any loan that's not insured by a government-sponsored entity. We have conforming and non-conforming. And then we have non-conventional, which carry more risk to the lender and investor, and is usually offered when a conventional loan is not attainable. Those are like the high money or the high cost, hard money lenders and things like that. People who don't fit into the normal box. Different types of loan types include a fixed rate, which is fixed for the life of the loan, or adjustable rate, which the initial fixed rate has an initial fixed rate period and then adjusts upward or downward depending on the mortgage terms. Fixed rate is typically 15, 20, 30 years, and at the end of the mortgage term, the loan is paid off. The pros to the fixed rate is the payment doesn't change over time. The cons are the payment remains the same, which could be higher than it would be with a different loan. Now, adjustable rate mortgages, as I said, it's initially fixed for a period of time, then the rate adjusts upward or downward depending on the mortgage terms. Usually fixed for a period of 2, 3, 5, 7, or 10 years. The pros of this is the initial payments may be more affordable. The cons are the payment may increase after the fixed rate period. Because interest rates are in the 2s and 3s, Most people not getting an adjustable rate. Everyone's getting a fixed rate right now because interest rates are pretty much at the lowest they've been for many, many years. So don't even think about the adjustable rate. We're just going to talk about fixed rate loans at this point. Most people are getting 15, 20, 30, for a first time buyer, you're usually getting a 30-year loan. It is going to be one of the most expensive things you buy. And, that's why we want you to really be educated about the process. And it also is one of the most important ways that we build wealth for ourselves and our families. So it is a great investment over time. And but it is a big investment. So we want you to be educated about that process. All right, special programs. There are federal, state, and local governments, as well as private and public and nonprofit companies that work hard to make homeownership affordable. They provide various programs throughout the country. Most of them are targeted to low to moderate income families and first-time buyers, and eligibility and other requirements may vary across various programs. So a first-time buyer is considered somebody who has not been on title to a property for 3 years. So if you had been on a property 10 years ago, and then you got off, you sold that house, and you haven't been on title for the past 3 years, you would be considered a first-time buyer again. Now, question for you that we get quite a bit is, if I make $100,000 and I have no debt, how much can I afford to buy in this kind of market? So we have this nice little sheet here that shows, if we look down over to where we have in the blue column, the light blue column, yearly income, no monthly debt. Let's look at $99,599, which is about $100,000. So if you make $100,000, you can afford a total house payment of $3,735. Loan amount would be $530,750, and down payment would be over here $19,250, and that's a purchase price of $550,000. So you're basically putting $20,000 down. Your monthly payments are going to be about $3,700 a month for that type of loan, depending on, what your interest rate is, right? So now with, let's say we have $500 additional monthly debt. Looking at this, it brings down our affordability. We can only purchase something in the price range of $475,000. And if we have $1,000, then we're down to about a $400,000 purchase price. So as you can see, just $500 of monthly debt versus $1,000 definitely affects your affordability in purchasing in Southern California market. Is very expensive, right? So that's one of the reasons we want you to work with a housing counselor to reduce your monthly debts, so you have more money available for your housing payment, and you can afford, these prices, what's happening right now in the market. So right now it's definitely a seller's market. So things are on being listed, and then they get 10, 15, 20 offers in a day or two. Somebody just told me about, they got 45 offers on one property in 2 days. So, and people are over bidding on the property. So say, for instance, they're, listing it at $300,000, they're offering $350,000. So if you're only qualified for $300,000 loan, and you say, well, I'll buy that for $350,000, that would mean you'd have to come up with the extra $50,000. You better have that money available, because they're not going to lend you that money, because the house is not going to appraise for that amount of money as well. So it's definitely important to figure out how much you qualify for and stick within that budget. Once you are working with a lender, stick within that budget. And when you're going out and looking at property, that you're not overpaying for property if you don't have that extra money available. All right, so this is just a little chart to kind of show you how having that additional monthly debt can affect the amount you're able to purchase. All right, any questions on that? As I said, the less debt we have, the more money we have available for our purchase. All right, so I think we're going to go ahead and take a break right now. It is, what time is it? All right, so it's about 5 after 6, a little after. So why don't we come back in about 15 minutes? So let's say 6:20. We'll come back at 6:20 and pick right back up, and we'll talk about down payment assistance programs, but we're going to take a 15-minute break since we've been on this for about an hour, a little over an hour, and I want you guys to be fresh. We're going to go ahead and take a 15-minute break. We'll come back at about 6:22 or so and finish this up. And hopefully, since you guys are being very quiet tonight, we'll probably get done a little bit earlier than expected. So be sure to come back. You do need to attend the whole class in order to be able to get that certificate. So I will see you back about 6:25 or so. All right. See you in a few minutes. Bring your questions and go ahead and go get a snack and take a stretch break. All right. We back? You got a minute to wrap up whatever you're doing. And we're going to get back to our workshop today. You guys are sure very quiet. All right, let's get back to our workshop. We're going to talk about down payment assistance programs, and we're going to wrap this up. All right, so down payment assistance programs are designed for first-time buyers, borrowers who need lower down payment options, and borrowers with less than perfect credit. We're going to talk about a few of them tonight. So there are conventional community lending programs that have low 3% down payment programs. Wells Fargo does provide $750 in closing cost credit for just attending this class. So if you do get a mortgage with Wells Fargo, let them know you have the certificate. They'll give you $750. So you just earned $750 tonight if you go with Wells Fargo. And I believe they also have a $5,000 grant in down payment assistance. Bank of America has a $7,500 in closing costs and $10,000 in down payment assistance, so a total of $17,500. Chase, U.S. Bank, Citibank, all of them have some type of down payment assistance program or first-time buyer loan. And almost all of them do require you to attend this class and get a certificate in order to be eligible for those programs. Majority of them, so it's important for you to do your research, check with the place that you bank with and see what kind of programs they have available. A lot of them have alternative credit evaluation for those with limited or no credit history. And many of the programs are more flexible on those ratios that we talked about. So they'll let you have a little bit more debt, a little bit of a lower credit score, and it's easier to qualify for those programs. So those are just a couple examples. We also have FHA and VA mortgages, which have minimal or no down payment. Minimal down payment with the FHA, no down payment with the VA loan. Have more flexible guidelines than conventional loans and no income limits. So in addition to down payment assistance programs, there are closing cost assistance. So there are lender provided closing cost assistance programs to help first-time buyers buy a home. And it pays towards the closing costs for qualified borrowers, may eliminate upfront closing costs. Usually no repayment is required. And majority of the time, these closing cost grants can be combined with other community lending programs. It's important for you to do your research and, determine what programs are out there. And research the areas that you're looking to live in, see what kind of programs are available there. One question that came in is, can I use my spousal support, child support as income? So yes, that would be qualified as income, as long as it's regular and steady on a regular basis. They may want to see a copy of your divorce decree to see, how much, or, the agreement that you have to see that this is how much money is you're entitled to every month. So usually they want proof of that information. But that's a really good question. So there's also a down payment assistance program called the WISH program that is available for first-time buyers. It is forgiven after 5 years. It can be used for down payment and closing costs. The deal with this program is you do have to get your first mortgage with an approved lender only. So somebody who provides the WISH program. Some of the advantages of it is it will provide up to $15,000 for each participating household, matching up to $3 for each dollar you contributed by the home buyer. So say you have $5,000, it will provide up to $15,000 in matching funds, or a total of $20,000. That can be used for down payment, closing, or a combination of both. Application process allocates the funds for homeownership based on the program eligibility and the funds available. So you have to do your research to see whether you qualify for these programs. And what I say is work with somebody, work with a lender that's familiar with down payment assistance programs so they can help you figure out which one do you qualify for. There are also community assistance programs that provide funds to assist with down payment and closing costs. It can be provided by nonprofit, federal, state, local agency. You want to look at them to see, is it a grant? Is it a loan? Is it forgiven, or will I have to pay it back after a certain? If I do anything with the property, sell the property, or refinance, does it have to be for paid back? Or sometimes they have requirements where you have to live in the property 3 to 5 years and then it gets forgiven. So in Orange County, the city of Santa Ana has up to $80,000 in down payment assistance if you purchase within the city of Santa Ana. The county of Orange also has the MAP program, which provides up to $80,000 if you purchase in certain areas. And you can just Google these programs to see what the eligibility is for them. They usually have income guidelines. They'll go by the number of people in your household and how much your household makes. And some of them have requirements that you purchase in certain areas, like the MAP program. There's also the Mortgage Credit Certification Program, which is a 20% tax credit. And I'll go over more of the details on that program a little later in the slides. So, question, do I have to attend homebuyer education class and get a certificate to qualify for these down payment assistance programs? So, what do you guys think? We've kind of talked about this, so let's see if you're paying attention. Send me a message in the chat box. Yes, yes, yes. You do have to finish the class. You do have to get your certificate. And majority of them will require you to have this certificate to be eligible for those programs. Good. You all were paying attention. I appreciate that. All right. So there's also Cali Check-In, which is our California Housing Finance Agency, has the Cal Plus loan, which provides a first mortgage loan that's insured insured through mortgage insurance and is fully amortized for 30 years. It can be combined with the Cal HFA ZIP program for down payment assistance and closing costs. There's the My Home Assistance, which is a deferred payment, simple interest rate subordinate loan that provides up to 3% of the sales price for appraised value of the property, whichever is less. And it's recorded in a second position. So it's 3% of the sales price. It is a silent second, and it just sits there until to help you get into the property. But then when you sell or refinance, you do have to pay it back. It can be used in combination with the ZIP program, and which can be used for down payment or closing costs. And they do have qualifying ratios up to 45%, mandatory home warranty insurance, and you do have to attend homebuyer education. So that's a very popular one that lots of people use to get into homeownership, and it doesn't require a whole lot of down payment. There's also the Golden State Finance Authority grant, which provides up to 5% of the grant, 5% of the loan amount in a grant for home buyers. It's a grant. It never has to be repaid. It's available anywhere throughout California, and you don't have to be a first-time buyer and can even own other properties for this grant. You do have some FICO score, have to have a higher than 640, and it does work with conventional Freddie Mac loans. So these are just a sampling of some of the programs that are available. There's also the Mortgage Credit Certificate Program, the MCC, which is not really a grant or a loan, it's a tax credit. And it entitles the qualified borrower to take a federal income tax credit. So because MCC reduces your federal income taxes, it increases your net earnings, it can help you qualify for the initial loan for a little bit more. It provides for a federal income tax credit, and it can be taken year after year. The anticipated tax credit can help first-time home buyers qualify for an initial mortgage. Again, it's one of those things you have to apply for as you're qualifying for the loan. So you're going to want to work with a lender that knows about these down payment assistance programs that can help you qualify. See which one's going to really fit you. Do we have any veterans on the workshop tonight? VA loan is a really great loan for individuals who have served our country. No down payment is required. It's through the Veterans Administration, and they guarantee the amount what the VA could pay a lender should a loan go into foreclosure. You can use it to buy or build a home, buy a residential condo, or repair, alter, or improve a residence. Since it doesn't look like we have any veterans, I'm going to skip through these slides and won't go too much into detail, but just know that the VA loan is a great loan if you are active member or have served the country previously. All right, so shopping for a lender. You're going to take your time, compare, negotiate. We say you should check 3 lenders out, get estimates from at least 3 lenders. You can check local and state financing programs. CalHFA has a list of people who they work with. You can read mortgage lender reviews at Zillow. You can also check with your local bank, credit union. You can talk to friends and family and talk to people who have purchased in the past, who have had a good experience, and they can provide you with some referrals. You should always check your lender out at the NMLS, and that's NMLS Consumer Access. Make sure they're licensed and make sure they don't have any dings on their record. And again, try to find somebody who works with first-time buyers and is familiar with those programs. You're going to want to compare important cost information. You're going to look at your loan estimate, look at your rate, buy down points, down payment. Does the loan include private mortgage insurance, which CalHFA does include mortgage insurance, so it may be a little bit more costly, but it may be helpful for people who don't have a huge amount of down payment available. What are the fees? What are the monthly payments? So the loan estimate replaces the good faith estimate and provides a description of all of those fees. So here's an example of a loan estimate. When you go into the lender, you say, okay, I'm looking to see, purchase this property. They're going to give you a loan estimate. It says, this is how much your loan amount is. This is how much your interest rate is. This is your monthly payment. Will it include a prepayment penalty, balloon payment? Does it include taxes and insurance? What is the closing cost? If you look at the bottom, it says estimated closing cost, estimated cash that you'll have to close. So it gives you an idea of what the cost of the loan is. So You can get estimates from individual banks and compare them and see what are the different fees that they're going to be charging you. What's the interest rate? And also, you know, we've had clients come to us and we review their loan estimate and they were being charged $5,000 for a termite just to do a termite inspection. And that was a junk fee that they were just throwing in there to make an extra $5,000. So it's really important to review your loan estimate. And if you have questions about it, you can always come to us and we will review it for you and go over it with you so that you understand all of the fees that you're being charged. It's important to negotiate for the best deal. Ask your lender or broker if they'll waive or reduce one or more fees, agree to a lower rate or fewer points. It helps when you're comparing apples to apples and you have estimates and you can say, hey, I went to Bank A, this is what they're offering me, can you meet it or beat it? Make sure that they're not lowering one fee while raising another. Once you're satisfied, then ask for a written lock-in to guarantee the rate, period, and number of points to be paid. If you do have issues with your credit, ask how your credit history affects the price of the loan and what you need to just change it. And you should be getting credit counseling prior to going out and shopping for a loan to make sure that you're getting the best interest rate possible. Ask questions if you don't understand. So the loan process includes, first you're going to do your research and education, then you'll do your loan application. Next, you'll do pre-approval. Next, you'll go through processing and underwriting. And lastly, you'll do approval and loan closing. So research and education is where you're going to sit down with your housing counselor, review your affordability, determine if you're mortgage ready, or if you need to do some things like clean up your credit, improve your credit score, pay down some of those debts. You're going to talk to friends and family and coworkers about their experience when they purchased a home, maybe get some referrals. Then you'll talk to mortgage professionals without any commitment. You can go online, do some calculations, see how much you can afford to purchase given your current income and situation. Just know that you can come to us for personalized one-on-one counseling sessions to review your situation, get an idea of how much you can afford, take a look at your credit, and get mortgage ready. Next step is the loan application. It's a lengthy document that has 10 sections. It includes the type of mortgage, term of the loan, property information, purpose of the loan, borrower information, your employment info, monthly income, combined housing expense, assets and liabilities, details of the transaction, declarations, acknowledgement and agreement, and then information for government monitoring purposes. So you fill out your application. Next, it will go. So step 3 is pre-approval or pre-qualification. So the difference between pre-approval and pre-qualification is a pre-approval is a written commitment from a lender for mortgage funding as long as certain conditions are met. Your information is provided to the lender and it's verified. Pre-approval does take more time than a pre-qualification because they're verifying your information, and it does carry more weight than a pre-qualification letter. Before you go out shopping with the realtor, you're going to need a pre-approval. How much am I approved to purchase? And then you go out shopping within that price range. Versus pre-qualification, which is an estimate of how much house you can afford and how much money a lender is willing to loan you. In a pre-qual, your information is not verified. It's a very fast and easy way you can get an idea of how much you can afford to purchase. Just to see, and you can just determine whether you even pre-qualify for a mortgage online, and it's done within 15 minutes or so. So how do you get pre-approved? Typically, you'll have to provide the lender with some documents that you would need to qualify for the loan, which includes your income records, pay stubs, W-2s, tax returns, any proof of undocumented income, credit report, a current one or at least one done within the last 90 days, as well as maybe some bank statements to show where you're getting your down payment from. Again, pre-approval carries much more weight than pre-qualification, and you want to get pre-approved prior to going out shopping for the loan. Next step, your loan will go into loan processing and underwriting. So the processor completes your loan package by ordering your credit report, ordering an appraisal of the property, verifying your employment, rent, and bank account balances, and then it's all sent over to the underwriter, who then reviews your loan application and decides whether or not to approve your loan. Step 5 is loan approval and closing. So let's say if you are approved, the lender will send a commitment letter, which formally states the amount and the terms of the loan. And then on closing day, that's when your loan is completed, they will provide you with a closing disclosure. It looks very similar to the loan estimate that I showed you earlier, except those are actual figures that, are what is costing you to close this loan. Double check your closing disclosure for accuracy, and all terms should be very similar to the loan estimate that was provided to you earlier. You're going to sign the documents to agree to pay the lender for the money borrowed, which is the mortgage note, and then give the lender rights to your property if you fail to repay the loan, which is through the deed, signing the deed of trust. So again, two very important documents are the loan estimate, right? And then the closing disclosure is going to look very similar to this. It's going to show you the loan amount, interest rate, what is your total monthly payment, total to close, all of your fees should be listed on there. It should be very similar. The closing disclosure should be very similar to your loan estimate. It might be a little bit different in that they're calculating insurance and taxes and things depending on what day you close, but it should be very similar. If you see something that doesn't look right, definitely question it. So again, here's a copy of a closing disclosure. Looks very similar to the loan estimate. Check these documents very carefully to make sure all of the information is accurate and what you agreed to. If there is a red flag, stop. I'm not going to sign till we get this sorted out. There is no pressure to sign things that you don't understand or that you don't agree to. And we've had plenty of clients come to us and say, they're charging me an extra $5,000, and they called us and they were able to stop the transaction and get it all figured out before they close the loan. All right, so if your loan is not approved, make sure to review the underwriter's decision with your mortgage professional. Common reasons for denial can include if you change, your income changes, maybe you're changing jobs, or you took on new debt, maybe you have insufficient assets, or perhaps the value of the property is less than the original agreed purchase offer. So like the example I was talking about before, you agree to purchase that house for $350,000. Let's say it's $300,000, but you offer $350,000, but the appraisal comes in at $300,000. You can only purchase, they're only going to give you a loan for $300,000. So sometimes the value of the property is less than the amount agreed to in the purchase offer, and therefore you'd have to come up with that remaining difference. All right, predatory lending and abusive lending practices are illegal, and they do combine certain products, practices, and prices that create unfair terms for the borrower. It can include packing or padding costs and fees, like that $5,000 termite fee that we saw in a client's paperwork, deceptive practices and fraud. Sometimes they use high pressure sales tactics. Don't sign blank documents, and certainly don't sign anything you don't understand. If it sounds too good to be true, it probably is. Watch out for the red flags. Know that you could stop the process and say, hold on, wait a second, I need to review this information. Don't feel pressured to sign things that you don't understand. All right, moving into shopping for your home, you're going to work with a real estate professional. There's a couple of types of agents. There's a listing agent, buyer's agent, and dual agent. So the listing agent is the seller's agent, and they legally represent the seller. They're paid by the seller from the proceeds of the sale of the property. Buyer's agent legally represents the buyer, usually paid by splitting the sales commission with the listing agent and the selling agent, sometimes paid directly by the buyer. And then there's a dual agent, which legally represents the interests of both the seller and the buyer in the same transaction, may be paid by the seller, buyer, or both, generally from the proceeds of the sale of the property. Just know if you're going to be working with a dual agent that they're working for the seller's agent in addition to you, and you want to make sure that they're giving you the best representation and they're getting you the best deal, and make sure there's no conflict with them working with the seller's agent and yourself. If you don't feel comfortable in that, then go out and get your own agent that's going to represent you individually. Realtor versus real estate agent. Realtors are members of the National Association of Realtors and subscribe to a code of ethics. So they have a little bit more credibility and ethics that they have to adhere to. Now, how do we find an agent? So you can do your research, talk to friends and family, get referrals from people who have had good experiences with realtors they've worked with in the past. You can check them out at realtor.com or through the local realtor associations. The Orange County Association of Realtors is here in Orange County, San Diego Association of Realtors, Pac West Association of Realtors. You can check out reviews and records on Zillow, Trulia. You can also look them up and see if they're licensed through the Department of Real Estate. Make sure they're licensed, that they don't have any dings on their record when you're working with, looking for a realtor. A good way to do it is to, talk to friends and family that have had good experiences in the past. You're going to want to interview them, come up with some questions, and interview a couple agents and see which one you feel most comfortable with. Just know you're going to be working with that person, and you want to discuss your needs and wants. They're going to, the agent's role is to do research for you on potential homes. They'll give you access to the homes that interest you. They'll help you prepare the purchase agreement and negotiate for the best price. They may refer you to other professionals, such as a home inspector. And they should always provide disclosures regarding real estate agency relationships. But you want to feel comfortable with that person, that they're working for you, that they're going to listen to your, concerns and really work for you. And if you don't feel that, don't work with that person. There's no reason you should be working with them. You should feel comfortable in working with your real estate professional. The buyer's role is to be mortgage ready, be respectful, communicate with your agent, tell them what's working, what's not working. Make sure they're going to really work for you in this kind of market, because you really do need somebody who's going to go out there and find you something that's within your price range and be aggressive so that you're able to get that property. There is also what's called a buyer's representation agreement, often seen as a green light to begin showing a client homes, and helps ensure that the compensation or the commission to brokerage and buyer's agent happens if a sale occurs. That means you're only going to work with that person. So be sure you want to work with that agent before signing any kind of agreement like this. And it's usually for a specific period of time. So make sure you want to work with them before you sign that. All right, how do we find the right home? There's a variety of types of homes out there. You'll have to do your research to see what kind you want. There's single family, detached single family homes, duplex, triplex, fourplex, planned unit development, townhouse, condo, or manufactured home. And there are also different types of listings for sale. We have a regular sale, traditional sale, short sale, or foreclosure or REO. Right now, we're not seeing a whole lot of short sales or foreclosures. Majority of it is traditional sales because most people do have equity in their property. So even if they're not able to afford it, they're able to sell their property and it's not through a short sale or a foreclosure. Now, setting your neighborhood standards, you're going to want to review the factors that are important to you. You may want to consider safety, the condition of other homes, schools in the neighborhood and the quality, distance to the job. If you're going to buy something out in Riverside and you work in Orange County, you're going to be making that commute. You're going to want to drive that commute and maybe do it a couple of times during traffic. Make sure that's going to work for you. You may want to look at recreational facilities, parks, playgrounds, how close is it to public transportation, shopping, other things that are important to you. You may want to write down a buyer's wish list, decide what you want and need in a home, and also a neighborhood checklist to make sure that the neighborhood you're buying in is the one that you want. You can rate the strengths and weaknesses of the neighborhood you're considering to purchase in and what's most important to you. There are a couple of tools you can use to research neighborhoods. NeighborhoodScout.com, Street Advisor, CrimeMapping.com, meganslaw.ca.gov, homefair.com/real estate school report. So you can do your research online to, check out the neighborhoods and see if it's going to work for you. All right, now as we're going through house hunting, you can search for homes online, get an idea of what they're selling for in those neighborhoods by going to Realtor.com, Trulia.com, Redfin, or Zillow. Just to get an idea, but generally your realtor is going to be doing all of the research and providing you properties that they think that are within your price range and in the areas that you're looking to purchase in and that are available right now on the market. But if you're just interested in getting an idea, you can use some of these online tools. Now, when you're viewing homes, you can do a drive-by. You can do open houses. Your realtor will set up times for you to go out and check out open houses. Be respectful as you're walking through the house. Don't show, oh my God, I love this house. This is the best house. You can do a lot of your research online and ask your agent to set up the open houses for you. Take pictures as you're touring homes. You might want to bring spouse, family, friend to go with you to kind of get an independent view of the property and view it at several times and at different times during the day. Make sure you turn off any music that may be playing in the house. Maybe they're using that to cover up the plane noise, the freeway noise that is the house is close to the freeway entrance or something like that. With the onset of COVID, lots of realtors are using virtual tours. So a lot of them, you can tour the property virtually to at least get an idea if it's going to work for your needs prior to going out there. But definitely do go to the house and see it in person as well. As you're looking at the house, you're going to want to check for issues like water where it shouldn't be, any kind of structural problems, serious finish problems, building lines that are not straight or true, utility system problems, and write that stuff down if you do see some things. All right, So you're buying your home. You found your home, now what? So once you find the home that you're looking to purchase, you're gonna make an offer. The offer is a written purchase proposal signed by you and anyone else that will be part owner of the property. Before you make an offer, ask yourself, have I been pre-approved for a loan? Like I said, usually they won't go out and show you properties until you're pre-approved. How much fixing does the house require? And can I afford it? Does this new home meet my needs and wants at the fairest possible value, possible price? How long has the house been on the market? We had one client that came to us this was like their 5th or 6th offer they had put out there, and they found a house and they ended up doing a home inspection on it, and it came back with all of these problems. It had, cracks in the foundation. It had a big tree that was, laying on the roof, plumbing issues, and they were actually considering buying this house. And I said, that's going to take a lot of fixing. So even though they were going to get some down payment assistance, it wasn't going to cover the cost of repairs. So they ended up backing out of the deal. It was not the right house for them. So you definitely want to do your research and know how much are these things going to be to fix, right? So here's a sample of the purchase contract that your realtor is going to have you complete and sign. Make sure to include the legal names of the buyers. Make sure everything is spelled correctly. Make sure the property address is correct. And it's going to provide the price you're agreeing to pay for the property. Make sure it's within your budget. And it's also going to include the number of days you're going to be in escrow after the offer is accepted. Usually 30 days, sometimes 45 days. You're going to sign this agreement, and by signing, you agree to all the terms of the contract. All right, so you submit the offer. The next thing that can happen is 3 things. Either 1, your offer is accepted, great, you're going to escrow, you're in the process of purchasing a house. Or the seller can send a counteroffer, and then they start negotiating. Or 3, the offer is rejected, and you decide if you want to submit a new offer, if it's allowed by the seller. Know your negotiating limit. Remember that the offer you settle on is the mortgage you will have to live with. So it's important that you don't overpay for property, because I think right now that's happening quite a bit. People are overpaying for properties. And if you have extra money laying around and you want to overpay for a property, certainly within your privy, most first-time buyers do not. So stick within your budget. All right, now they've accepted your offer. What happens next? You go to escrow. Escrow is opened. The escrow is basically the time period when the offer is accepted and the loan is approved, closed, and the deed is recorded. Usually it's about 30 days. Escrow is a licensed escrow company or impartial third party that will hold all the funds and disperse them accordingly to make sure all parties are paid and all contingencies are satisfied. So the escrow timeline is within 3 days. Your earnest money or good faith deposit is going to be paid as a deposit on the home. Usually it's about 1 to 3% of the home's purchase price. If the sale is successful, the earnest money goes towards the down payment. So they are going to ask you to put some money down to show that you're serious about buying the house. Within 7 calendar days, you'll give pre-approval letters to the seller, verify your down payment and closing costs are available. Within 7 to 17 calendar days, you'll do your inspections, review reports and disclosures, request repairs, and remove any contingencies or cancel the sale of the property. Now, what are contingencies? Contingencies are events or tasks that must happen before you or the seller can complete the purchase. If the contingencies are not fulfilled before the closing, the sale is canceled and you get your earnest money back. Typical contingencies include loan approval or financing, appraisal, home sale, title, etc. So make sure you discuss that with your realtor. If you're worried about being approved for the loan, then you want to say, hey, if I'm not approved for this loan, there's a contingency that I can back out of this deal. All right, let's talk about home inspection versus appraisal. So home inspection evaluates the structural and mechanical soundness of the property for the buyer, whereas an appraisal determines the property's fair market value on it. It's done on behalf of the lender. So two different things. Appraisal for the lender, inspection for you as the buyer. Now, home inspections are super important. It's a professional person going through the property, looking at the conditions of the house, and to see if there's issues that need to be addressed. It may change your decision about whether to purchase the home or not. As I said in that previous example, these people were our clients were desperate to purchase something, but when they got the inspection back, it was horrible. There was about 28 things in there, and one of them was the foundation was cracked. I said, this is going to cost a lot of money, so you're going to want to talk to somebody, contractor, to see how much it is. But honestly, I wouldn't suggest you purchase this property. It can save you a lot of money on possible problems you didn't know about prior to, and it does reduce the chance of any costly surprises once you buy the home. So your realtor will usually work with a lot of inspectors, and they can find them through the American Society of Home Inspectors or the National Association of Home Inspectors. Typically costs between $300 to $500. It is paid upfront, but just think of it as a small investment, highly recommended. Do not waive your opportunity for a home inspection, because they're going to go detailed through the property to see what kind of problems are there and give you a report at the end of it. It's a good idea to meet the inspector at the property, and it's really important for you to ask questions about things you see. You can do research, see how much things are going to cost, and work with your realtor. Maybe your seller will pay for some of those things. Some red flags include environmental hazards such as water contamination, radon, asbestos, lead paint, underground storage tanks, moisture in the basement or attic, defective roofing or flashings, insect infestation, termite damage, chimney settling or separation. A home inspection is going to tell you all of these things. So HUD really wants us to encourage you all, get a home inspection for your protection, and so you know what you're getting. Be an informed buyer. It's a small price to pay, and if you have to back out of the deal because of the inspection, that's okay. You only lost $300, not $10,000 because you need a new roof. All right, so they're also going to order a title report and title insurance. Title report is a legal document from a licensed title company. It includes description of the property and any applicable liens on the property. You and your agent should review this document. Title insurance, a title insurance policy covers the lender or a property owner against defects in the title and or challenges to their interest in the property. So usually title insurance, it is required for the lender. It's optional for you as a buyer, but the lender is going to make sure that the title is clear before the property is transferred. But it does, title insurance policies cover the lender. All right, so you're going to do your closing tasks, do a final walkthrough with your agent, verify the condition of the property. You're going to purchase homeowners insurance. You're going to get a copy of your closing statement, which used to be called the HUD-1, but now it's called the closing statement. Again, looks very similar to your loan estimate, shows all of the costs of the loan. You're going to sign loan documents and provide down payment and closing costs to escrow. Escrow closes when the loan's funded. They notify all parties of closing and record the title, and you receive your keys. You've purchased the property. All right, so any questions on the purchase offer, purchase contract, escrow, closing tasks? Everybody good on that? All right, then we go into homeowners insurance, or also known as hazard insurance. It is a type of property insurance that covers the private homes. It is required by your lender. It protects your asset in the event of structural damage and pays to replace personal belongings within the home if they're stolen. Also provides liability coverage in case accidents may happen on the property. If you don't have or you let your homeowner's insurance lapse, the lender will provide a policy for you. You don't, and it's very, very expensive. So you want to always make sure that you have your homeowner's insurance up to date. Coverage, you'd be covered for fire, structural damage, liability, theft, temporary living expenses. You can purchase additional coverage for earthquake, extensive soils, floods, hurricane, landslide, or subsidence. Not really common in the California area. So let's go over some common questions we get, coverage questions. So say, for instance, your neighbor falls in your home, breaks her arm, and goes to the hospital for care. Do you think you'd be covered? Yes, we'd be covered under our homeowners. If a car careens around a curb and drives into your living room, would we be covered? Yes, because that would be structural. How about a skunk gets into your home and now everything stinks? I mean, if you had to pay for a professional cleaning service, yes, it probably would be covered. Let's say a foreign army invades the United States, destroys your home in the process. Probably not, in that, you know, that's a scenario that I'm not sure that they would cover you for. Or perhaps your upstairs neighbor has a leak that causes a flood in your condo. In that case, it probably wouldn't be your individual homeowner's insurance. It probably would be your HOA or your neighbor's upstairs insurance, since the flood came from them, but it was through the wall, so it most likely is covered by your HOA. All right, so as you're shopping for homeowners insurance, you're going to want to know the difference between replacement cost and actual cash market value. Replacement cost is the amount it would cost to rebuild or repair your home with similar materials. Actual cash or market value pays for your loss, but often doesn't pay enough to fully repair and replace the damage. You're going to want to shop around for your homeowner's insurance. Make sure the company's licensed, ask questions, and know that you can usually bundle it with your auto insurance and get some discounts for adding those all together. But shop around to make sure that you're getting the best deal and a reputable company. You're going to want to make an inventory list. Make a list of your personal belongings, include serial numbers, take pictures, videos. There's a lot of online apps that provide help with home inventory, so you can use those to help inventory the things in your home. Let's talk about the difference between home warranty versus home insurance. So home warranties are optional. Homeowners insurance is required for the mortgage loan. So a home warranty covers plumbing, electrical, heating systems, and major appliances, such as refrigerators, dishwashers, ovens, etc. It costs between $250 and $500 a year, depending on the coverage. Plus, you'll have to pay the cost of a service call, usually between $50 and $100. So it provides a warranty for the home. And if you had something go wrong, say your washer goes out, you call the home warranty company to explain the situation. They send a appliance repair provider who fixes the appliance. All expenses are covered, but the warranty holder has to pay that $50 to $100 service call fee. Now, homeowners insurance is the one we talked about earlier that covers damage to due to occurrences like fire, windstorm, theft, loss, etc. Usually between $300 to $1,000, depending on many factors. And they only cover the cost of the repairs and do not hire contractors to make the repairs, and they may not cover the entire cost. So that's the difference between the homeowner's insurance and a home warranty. All right. Living in your new home, you're going to want to get to know your home. Look at that inspection report, talk to the seller, talk to neighbors, write everything down. Be sure you know where the main cutoff is for water or gas, where the electrical switches, the fuses or circuit breakers, if it has an alarm system, how it works, how you shut it off, hot water heater, thermostat, etc. Ask questions as you're doing your walkthrough to the property. You're going to want to post emergency contact numbers and have an occasional fire safety inspections. Make sure you're stay current on testing your smoke detectors. Have a fire extinguisher in the home, usually in the garage and the kitchen. Make an escape plan with your family in case of something, fire or any kind of disaster. Also make a preparedness kit, and if you do have gas in the home, have at least one carbon monoxide detector. I do believe that's a law now, so before selling the property, they have to install one of those. All right, so you want to protect your investment once you're in this home. Home equity is the current value of the property minus the amount you owed on any outstanding mortgages. So let's say you bought the house for $300,000, but now it's valued at $400,000. That would mean you'd have $100,000 in equity. Equity is an asset that will help you build your financial future. When you borrow money using your equity, it's called a home equity loan or a HELOC. And if you don't repay the loan, the lender will collect your home as collateral. You want to be very careful in utilizing your equity and making sure you're using it to improve the property and not just to go out and buy things, purchase boats and RVs and things like that. It's really how you build wealth and, improve your financial situation for your family. There are lots of online resources and rebates through Southern California Edison, SDG&E. You can find rebates and incentives for buying energy efficient appliances, installing the thermostats, the digital thermostats. They'll give you credits or rebates for that. There's also lots of do-it-yourself advice places where you can learn how to do home improvements yourself. You can Google it, use YouTube, lots of do-it-yourself network, and different resources available if you're going to do some improvements yourself. Make sure you do the research and find out how much things cost before you pay people so that you're not being overcharged for any kind of home improvement projects. As I said, a lot of the energy, the electric and gas companies are giving you benefits and rebates if you purchase Energy Star products. A lot of homes are now Energy Star efficient. So check those things out and see if you can get some rebates or refunds by when you're purchasing new appliances and you're buying energy efficient. Also, be very careful of the solar panels and what the cost is for those things, because we've had a lot of clients who have tried to sell their property and they have solar panels on, and they didn't realize that when they're selling their property, then the person buying the property has to qualify for the solar lien that's on the property for $30,000 for these solar panels, which is an extra $30,000 they have to purchase, right? So before you go and sign up for any of those programs, make sure you know what you're signing up for and what it's going to cost. And we've had a lot of clients not be able to purchase a property or not sell their property because of those solar panels. So I'm not saying they're a bad investment, because it can help you save money with your electric bill, but just make sure it's making sense and that you understand the terms and conditions of what that's going to entail. Because a lot of them say it's not going to cost you anything, it's going to save you money on your property taxes and all of that. And in the long run, it doesn't, because they've signed up for these bad deals. So be very careful with those solar panel installations. So we're all covered under federal and state fair housing laws, and as it relates to homeownership, it is illegal to refuse or sell or rent housing based on your race, color, religion, national origin, sex, familial status, disability, which includes mental or physical disability, and no one may refuse to show you specific location, fund a mortgage, provide different information regarding loans, or discriminate in appraising or offering different terms or conditions based on all of those protected classes. And there are actually more protected classes under the state of California. So if you do feel like you've experienced discrimination or you have quick questions about it, you can always contact us. We do work with the Fair Housing Foundation, who's a local fair housing partner, and we can refer you to them for more information and filing complaints, or even if you just have questions about it. All right, so what comes next? If you're already approved for a loan, you're going to take your home buyer certificate, send it over to your lender, down payment assistance program, and then they're going to give you credit for it. If you're ready to get pre-approved, you're going to contact the lender and see how much you qualify for. If you're not sure where you are, or if you're ready, you're not sure if you're ready, you want to learn more, you can schedule a one-on-one counseling session with our housing counselor, can go over your credit and different information, your income information and your budget to see if you're mortgage ready. If you need to improve your credit, we can also help you with that. So I will need you to send me your intake forms in order for me to provide you with your certificate, and make sure you complete that budget section as well. Some keys for successful homeownership: avoid risky loans. If it sounds too good to be true, it probably is. Make sure you make your monthly mortgage payments on time. Stay current on your property taxes. Make sure you maintain adequate insurance. Keep your home in good shape. Keep an emergency fund ready in case something goes wrong and you have to pay, expend that money. Avoid borrowing against your equity for consumer purchases. And if you do run into trouble, seek help as soon as possible. You can contact us. We do provide foreclosure prevention counseling if you're having trouble making your payments once you are in your home. All right, so important to read all the documents, ask questions, know you can get help from us, know your budget, stick to it. Check out your realtor at the Department of Real Estate. Check out your lender at the National Mortgage Lending Consumer Access. Do look for down payment assistance programs in the cities and counties and areas you're looking to buy. So say you want to purchase in Chino, out in Riverside, or San Bernardino. Go to that website, go to the city's website, the county's website, and see if they have down payment assistance programs available. They'll usually list them. They'll also list the nonprofits that are available in that area that may be administering the down payment assistance program. Make sure you work with individuals who work with first-time buyers, are educated with first-time buyers, and about first-time buyer loan programs and down payment assistance programs. You can already check off educate yourself since you just did that tonight. Good job for you hanging in there. And as I said, I will need you to complete our intake form. And we have an online form on our website. If you've already done it, then you're good to go. I will need this back so we can provide you with a copy of your homebuyer certificate. And we will be following up with you after the workshop to offer you one-on-one counseling if you'd like to take advantage of it. If you've already started with the providing us with the intake form, we'll just go ahead and schedule a time for you to meet with our housing counselor. All right, so questions you guys have? Additional questions? Let's see. How long does this HUD certificate or class last? So typically the HUD certificate is good for 1 year. If you weren't able to purchase within a year and you came back to us and said, hey, I took the class over a year ago and you need an updated certificate, we would give it to you. You don't have to take the class again. I'm not sure if you go to other agencies how they're going to handle that, but we would certainly give you an updated certificate if you needed one within the next, couple of years. So next steps, like I said, make sure you complete our online intake form. If you do have questions, feel free to let us know. You have all of my contact information. You can email me. You can send me an email. And if you do want a copy of the PowerPoint, just send me an email. I can send you a copy of the PowerPoint so you can review it for yourself. And again, if you do have any additional questions that come up, here's my contact information. You can contact me at cdt@conniedt.com. You can go to our website at HomeownershipOC.org. We have lots of information and resources on there. You can also give us a call at 714-204-2314. So any other last questions? You all might have any questions, or if something comes up, we're happy to answer questions for you. Provide you any kind of resources. Perhaps you need some help with finding down payment assistance programs. Like I said, best way to do it is you can check with the city, the county, and the state where you're going to live, right? So I talked a little bit about CalHFA's program, so that's a state program. But if you're looking in a particular city, go to that city's website and see if they have any down payment assistance programs. You can also check with the county. If you've already filled out the intake form, you're good to go. You don't need to do that again. So, but if you do need to find the intake form, it is on our website at HomeownershipOC under the programs page, and we will provide it to you. You complete it online and it gets emailed to me. Once I receive it, then I will send you your certificate. All right, well, it looks like I don't have any additional questions, so I think we can wrap it up. As I said, if you do end up having any questions that come up later on, feel free to outreach to us and we'll be happy to provide you with that answers. All right, so Adrian, you already completed the intake form, so you are good to go. And you already completed your budget, so you are good to go. So I will be emailing you out your certificate. If I have your intake and budget, I'll email you out your certificate. If not, I'll send you a reminder so you can send that information. All right, so thank you so much. I appreciate you joining tonight, and I hope you have a great rest of your night. All right, thank you.